You for joining today for our quarterly investment update. Like I mentioned, Amanda's out sick today with a sick child, so you're stuck with just me today. So before we start, a few housekeeping notes I'd like to go over. Again, if anybody has any questions, you can click on the chat box or the question box on the lower right-hand side. Ask any questions throughout the presentation. We'll take some time at the end to get to those questions. If there is not enough time to answer all the questions, I will get back to you with an answer as soon as I can. So for those of you who are new to this and don't know who I am, my name is Chris Gauthier. I'm the Chief Investment Officer of Stonehearth Capital Management. I'm also chairman of the IC committee, which is the investment committee, which sets the investment philosophy and process for all of Stonehearth Capital Management's clients. So with that, let's jump right into the presentation. I titled this one, Turn the Page. I'm here. And again, it's one of my favorite Bob Seger songs. And in addition to turning of the calendar into the new year, the evidence, as you will see, is pointing to a potential turning of the page as well. I'm going to environment with higher prices. And I just apologize here. Just have to get one thing set. There we go. Environment with higher prices, higher rates, but continued growth, right? Which is really good for some parts of the market, but not so much for others, as we'll see. Before we take a look at the weight of the evidence and finding the signal through the noise, which is what we always try to do here at Stonehearth Capital Management, let's set the stage by taking a look back to see how we got here. So what we're looking here is Q4 2024 performance. As always, anything in yellow is anything that doesn't fit neatly into the fixed income or equity bucket. Anything in blue would be domestic assets, or anything in the US, like the NASDAQ was up a very healthy 4.91%. The S&P was up 2.49%. And anything in purple is fixed income, and anything green is an international. So really when we're looking at performance here, it really was driven by a recalibration of interest rate expectations. And you can see that in the tails, right? So expectations of higher rates for longer. You saw the dollar go up 9%, right? The US has higher rates than the rest of the world. People like that, and they'll kind of invest in US Treasury market, which gives the dollar a boost. We also saw oil kind of come up due to economic growth. And then we look at the tails, what gets hurt by higher rates? Long-term treasuries, right? We know that that's duration. That's when rates go up, long-term treasuries go down in price. International, stronger dollar, right? Higher rates, stronger dollar hurts international returns. REITs, they like lower rates too. So you can see it really was driven by the interest rates. But we also saw concentration return. You can see that by the dispersion of returns, where the NASDAQ was up 4.91%. S&P up 2.5%, really driven by the Mag 7. As you can see in the next chart, it really was a Mag 7 performance in the fourth quarter. So what we're looking at here is three different securities. They're ETF that trade on an exchange, and they track indices. Now, the first one we've seen on the previous chart, that's in purple. That's 2.49%. That is the S&P 500 index. When you look at the top one that's up 15%, that's the Mag 7, right? So those are the names we all know: Netflix, Microsoft, Amazon, Tesla, Nvidia, and the like. So again, that was up 15%. And then when we look at the average stock, right, that's that RSP, that's that blue, that's the equal weighted S&P 500. That's just taking the S&P, which is the purple line, and then rather than weighted by market cap, which that index does, it takes, if you only held one share, an equal weight of each company in the S&P 500, you would actually end up with a negative return. So the way to read that is that the average stock in the S&P 500 was actually negative in the quarter, not positive. That positive return was really driven by that Mag 7. And we take a longer standpoint, it's pretty much the same exact thing that we see. You know, the Mag 7, gold, and everything else. So we see the longer term performance. You have gold as the best performer. Again, really have to do with concerns about the debt, and we'll kind of go into that a little bit in a few charts from now. But it was really a good year to be invested. And as we said, concentration on performance. It was not just a fourth quarter issue like we saw, but also over longer time periods. But with the difference really being that at least over the longer term, other stocks were able to generate very healthy positive returns. So we see the Nasdaq and S&P 500 leading the way again. Again, those are in blue, up there 25%. But we see very healthy returns, even in EM, up 6.5%, international up 3. We look at US small cap, almost up 8.5%. So even though you weren't up 25%, you still had pretty decent returns in the marketplace, given where you stand. And then when we look at the concentration risks, the same securities we're looking at before from the quarter for 2024, you see the Mag 7 again up 64%. You know, average stock still very healthy though, up 13%. So that was a big difference. Does trail the Mag 7 by a wide margin, which does increase the risk of potential weakness in the top holdings of the index, which we will see in a few slides. But before we take a look at the equity market, let's see what the signal, the economic data is telling us in the marketplace. So we'll always start off with the Fed and what the Fed's doing because they have such a big impact on the marketplace, or at least they did in 2024. They may be decreasing in 2025. And that's really because they now start to agree. So we look at those lines going back in history to 1993. Those are the Fed funds rates, right? You see it was up at 7% back in 99, really collapsed after '08. You see the recent rise after the COVID-induced decline in rates up to almost 5.5%. Once you get to that dotted line, those are predictions. And there's two of them out there, right? There's the FMOC, that's their predictions of what the Fed's going to do. And that green dotted line, which is almost right over that in the short term, over the blue line, market expectations. What does the market think the Fed's going to do? Where do they think interest rates are going to move? Well, you can see from the lines as they overlap, at least in the short term, which is really all that matters here because data can change in 2026, but at least in 2025, the Fed and the market are in line, right? That kind of as they became in line, that drove performance in fourth quarter, right? As that investors recalibrated their holdings based on this. It was good to see there was not a rush out of risk assets with this recalibration. That's good. There's just acceptance and agreement that we're in a higher for longer environment. I mean, just think back 6 months ago, the market and the Fed were expecting maybe 4 to 6 cuts in 2025. Now down to 2. Maybe 2, maybe not 2. Why? Well, it's the data, right? So let's take a look, starting with the amount of money sloshing around the system, which we can see is elevated, that may be causing this change in rate expectations. And we can see from monetary conditions that from the friends at NDR, a measure of how much cash credit and how easy or hard it is to get. Right? Very easy as in the bullish zone, right? Financial markets like easy conditions. There's a lot of money out there. They lead to higher equity prices, all things being equal. But again, we know not everything's equal, and there's a downside eventually. As we all know, money doesn't grow on trees, as our parents always told us. It is true that it doesn't grow on trees. It has to come from somewhere, right? And right now, the main supplier is the U.S. government. Not a problem yet, but the seeds are being sown for a problem. We are approaching record levels. And what we're looking at here is a different way of looking at the government debt. We're not looking at actual debt. We're not looking at debt to GDP, which I'm sure you all heard about. This is the federal net interest expense. So this is how much the government pays in interest. Think about your credit cards, right? You always pay your principal. Well, hopefully you pay your principal every month and an interest rate. This is just the interest. And you can see that solid line is where it's been throughout history, going back to 1965. You can see we're not at record levels yet. 1990s was a little bit higher, but we're not headed in the right direction. This is going upward to the right. You can see that little bend down in 2025. That's because this is from the CBO and they expect the Trump tax cuts to expire. That's their baseline. That's probably not going to happen. So this could even go up quicker. The main takeaway from this is unsustainable in the long run, right? Something needs to give. If it gets up to 22%, it'll be the biggest line item in the budget, more than Medicare, more than Social Security, more than everything out there. So how is this affecting the economy? We judge by the labor market. And the first thing is very supportive of economic growth in the short term. We see real wage growth. That's that blue line, right? You can see it up at almost 3.9%. So again, strong wage growth. And we're almost at full employment, unemployment rate of 4.2. There's always some unemployment in the economy. There's always some friction. It's a guesstimate as to what that rate is, that natural rate of unemployment. But, the majority ends somewhere around that 4%, 3.8%. So with the 4.2 number, if you want a job, you pretty much have one or can get one very quickly in the marketplace at the aggregate level entirely. So it's really tough to see your way to a recession or lower rates, right? Because you lower rates when you see slowing economic growth. We just don't see it. And then we take in conjunction with the inflation data, which is improving, but it's still a long way to go. We can see that continued improvement. So what we're looking at inflation is a few different ways here. We look at the top chart. This is the CPI. This is what they call the headline index. This includes everything. You can see that while we definitely have seen a lot of improvement down from the 9% back in 2022, we're still only at 2.89%, which is still a long way off from the Fed's preferred 2% measure. Then we go down, we can see it's even worse when we look at core. And what core does is it takes out food and energy. No idea why. The Fed likes to do that because they said food and energy is so volatile. But if you live in the real world, that's what the majority of your budget goes to, the housing. So I'm not sure why they exclude it, but they do. If you exclude it, it's even worse. It's at 3.25%. So still a long way to go. Then in purple below, we have the PPI. That's a purchasing price index, or producer price index. What this is the beginning of the economic cycles, that those raw goods that companies are purchasing. Again, so if you think about it logically, if companies pay more for goods, then that gets filtered down into the prices that consumers pay. And you can see that is, again, lots of improvement from 2022, but not nowhere near where we need to be to get inflation down to that 2%. And finally, that green is inflation expectations. Do see some improvement. Again, this is what investors think inflation is going to be over the next 5 years. And you can see that they don't believe the Fed's going to actually get down to 2%, right? So they have it up there at 3%, which is above average. Uh, so again, the Fed has a dual mandate, jobs and prices, right? And both are supporting no rate cuts. So if you say you're a slave to the data, you only do what the data tells you. When you look at the data, it's saying don't cut. So again, it does, however, help economic growth, right? Healthy labor market is helping the consumer. Rising prices is normal in a growing economy, as long as wages are too. And that's what we're seeing in the data. So we're seeing a very strong economy within this, and no need to cut rates. So looking at the consumer, and we always go by the consumer because they're the biggest driver of economic returns, they're in pretty good shape and feeling good. So the kind of way to look at it here is the top rate is the mortgage rate. Now, definitely elevated compared to history at 6.85%. But, over 60% of the mortgages out there have a rate of 3. So when you look at the next graph, the green, which is home prices, you can see why they feel so good. If I'm sitting at my mortgage at 3, 4%, but this line showing that my home is increasing in value every year, I'm feeling pretty good. Does not help new home buyers, 100% agree. But again, taking at the aggregate, consumers are feeling pretty good due to house price appreciation when they're sitting at a mortgage at 3, 4, and 5%. And you can see that that's getting into the sentiment. That's the next chart. That's in pink up at 74. You can see where consumers are continuing to feel better about their economic picture. You can see that increasing up to 74. And finally, what's most important to us, they're actually acting on that. The blue line is the retail food and services sales. So our consumers actually spending. And we can see at that blue line, which is, again, looking backwards, but it is showing that consumers are spending. And we want to see if it's going to continue to do this. We look at the PMI numbers. So these are surveys done by the federal government asking, consumers, companies, are things getting better, staying the same, getting worse? You add that all up, you get a score. If it's above 50, it says we're in economies in expansion. And you can see from that red line that the consumer has been in expansion for a while and is actually accelerating into this. So it's up at 54. So good signs, consumer spending, which we saw in the sales numbers, and they plan to spend moving forward. What's also kind of helping is this manufacturing number. Now, definitely been weak for a while and under the 50%. But you can see that really starting to head up and head to that 50%. Again, need to see continuation. You can't predict the data, but if this continues, you can see where we're going to get strong economic growth in the manufacturing sector, which is going to increase the economic growth that we're seeing from the consumers. And we can see that translated into the numbers. When we look at GDP, we see very strong GDP growth across the complex. So again, this is GDP growth quarter over quarter on an annualized rate. So this is the number you see quoted. We look way back in here over to the right. The last number is 3.1%. So as of 3Q 2024, again, data has always lagged. We're growing year over year on a quarterly basis, 3%. Very healthy growth rate, right? Like you can see that. You can see that really we haven't had a negative quarter since first quarter 2022. So again, it's been pretty consistent and pretty strong growth across the board in the GDP numbers. And this is not just a US thing. I know we best house in a bad neighborhood. The US is leading the world, but there is growth across the globe, right? In international markets, EM markets, not just the US. Yes, there's a few soft spots in Europe, right? There's a number right here in the developed, and you can see some oranges, but still close to expansion. No heightened recession warnings. Global growth remains strong, which we can clearly see in our next chart from the friends at Ned Davis, and they put all this data together in what they call a recession watch. And what this is doing is trying to show, giving all this data, what are the probabilities given history that we're heading into a recession? And that's this bottom chart, the squiggly line. You can see that it's a pretty good predictor that when it tends to rise, there tends to be a recession. We look where we are right now, we're definitely heading in the right direction if we don't want a recession, which we never want a recession anywhere. So again, we're seeing good, strong data from Ned Davis, no recession in the future. You know, Given all this, recession odds are dropping, good for the economy and most stocks, but does not indicate less rate cuts, right? Maybe needed. So a more higher, stable interest rate environment may lie ahead as we turn the page in 2025. So before we move on to the equity land, to sum up the economic environment, really we have a strong consumer, right? Helped by increasing wages, low unemployment, rising home prices, which is really supporting an expanding economy, which should help risk assets. Although sticky inflation is still a concern, it's being outweighed by the strong economic growth we're seeing. So the economy's doing all right. So let's see what it says about the equity market. And we begin and always start with valuation. And we can see that we have not seen any improvement since we last spoke. What we're looking at here is the forward price earnings ratio. So you can think about it this way. What are you paying for $1 of earnings? You see, going back to 1994, we had the average of 16.9. So that's what you would pay on average in this time period. And then we have the standard deviations, which really show extreme levels, right? So if it's greater than one standard deviation, you can call it extreme overvalued. Less than one standard deviation, extreme undervalued, like we saw in '08 and 2012. We're far away from being undervalued. We're actually over the one standard deviation extreme value. And you can see that's not just PE, it's also other measures. CAPE, which just takes this PE and extends it 10 years to adjust for inflation. It's 1.5 standard deviations overvalued. Dividend yield, almost 2% overvalued. Price to book, just what you're paying for all the assets on the balance sheet, very expensive compared to history. And my favorite, price to cash flow, because we all know that companies create cash, which generates earnings, which generates increased value, is still at 16.4 times, very high compared to the history of 11.34. Stocks look better when compared to bonds, but comparing apples to oranges, when we look at it overall, we're still very expensive. And so why do we worry about valuation so much? Extremely elevated poses a risk for future equity returns, which JP Morgan was kindly enough to quantify for us. So this is the chart. You can say, why do we care about valuation so much? Why do we look at it? So what are we looking at here? So we'll take the chart on the left. This is the forward PE and 1-year return. So again, the same data we looked at before, 21.5 times. On the x-axis, you see the times, right? So what's the PE ratio throughout history? And this is going back to 1999. Over here is the returns after 1 year based on the starting PE ratio. So if you were at 11 times earnings, you can see, 20, 30%. Where are we right now? 21.5. What has happened throughout history when you started a 1-year period at 21 times earnings? Well, returns have not been too great, right? It's almost at zero, flatlining. Still positive, but not great. And again, this is just probabilities, right? There are some that did worse. There are some that did better, but on the probability is you're not likely to generate a huge return from this PE ratio. Even worse, when we look out over the 5-year analyzed returns, right? Because you can see much more clustered returns. And you can see that around here, the 21.5, it doesn't really get much better than, single-digit returns here on a majority basis. So again, not a guarantee, just increases the probability of poor returns moving forward when you start at a high valuation rate. But we must look at the entire weight of the evidence, right? Including concentration risk, which can be seen on the next chart, which goes a lot to the valuation concerns we're seeing in the marketplace. So when we look at the S&P 500 on the total valuation, we can see that it was 21.5. But when we break it out to those top 10 stocks, so now we're doing the Mag 7, but we're also adding JP Morgan, Berkshire, and Broadcom. And if you want to look at those Mag 7, you can see it right down here, listed out here, and their weights in the S&P 500 index. And we saw them really, as you expect, the highly concentrated performance, it has led to a concentrated valuation picture, highest it's ever. So again, 29.8 for the top 10 stocks. The remaining stocks look a lot better, right, at 18.2. So taking those out, that's where you get to 21.5 for the S&P 500. Still expensive, but a lot better on a valuation picture. But we see all this, the result of all this is that we have this concentration risk in the S&P, which is what we're looking at here. This is those top 10 stocks as a percent of the market cap of the S&P 500. And you can see it's never been higher, up at almost 40% right now, 38.7%. So very elevated, highest it's ever been. But if you're willing and able to move away from the headline index and that Mag 7 top 10 names, you can see a much improved valuation picture, which we can see on the next slide. So you can see what we're looking at is just taking the equity market and breaking it out into different buckets. We see the S&P 500, which we're all familiar with, what we've looked at before, but we can also, there's other parts of the market. So other than the S&P 500, let's look at the next 400 biggest stocks in the US economy. And you can see from the valuation here, it looks a lot better. Not hugely attractive, but still better. When we go to the next 600 largest stocks, so we get, again, the smallest of the economy, you can see you get a much higher, better valuation picture. Look at the Russell 1000, still value. When you move overseas, think about Europe, England, France, again, much more valuation support. And even if you don't go overseas, you just look north to Canada, seeing a better valuation picture. And then you look over to the EM, when you look at China, Brazil, you're getting a much better valuation picture. So again, looking at the entire universe, if you can move away from the S&P 500, there are some pockets of attractiveness. I mean, look at the small caps, the overseas. Not every piece of the equity market is overvalued and will react to the same to the higher rates for longer. So valuation is a very large part of return expectations, as we saw in the JP Morgan chart, but certainly not the only part. Right? We have sentiment, trend also play a role. So let's look at trend first, which is very strong and very positive. So look at the S&P 500 now again, that index, which includes the Mag 7 and the top 10. So strong uptrend, right? This is on a weekly basis, the prices going back. You can see a very strong uptrend despite a slight dip in December. This is support and resistance line right here. Anytime you see red, that's resistance, and all it is going back in time, looking at places before where there was a fight over the market before it turned one way or the other. Support turns into resistance, resistance turns into support. The good thing to know is that green here is that there is a lot of support down here, and we're far from that. And then we look at the moving averages. This is the shorter term moving average at 50 weeks. This is at 200 weeks. And you can see upward sloping to the right. So again, what the trend is telling you in all these moving averages that it slopes upward to the right, that the cyclical bull that began October 2022 is still alive and well, right? Even with that late quarter weakness in December, we haven't broke any support, resistance, or trend lines. So still having a positive influence on future equity prices. Breadth, again, another declining breadth is a cause for concern. We can see when we look at this, we look at the ACWI now, so we're taking global stocks, and these are percentage of stocks above the 50-day moving average, and these are stocks above the 200-day moving average. Why do we look at this? Well, we know from throughout history that bull markets are strongest when broad, when it has a lot of support. When there's less support, they tend to be a little bit weaker. So you just think about a table. If it has 4 legs, it's very strong. If it has 1 or 2 legs, weak. Anything could knock it over. And that's what we're looking at here. And you can see that there's, despite this little dip, not quite in the danger zone yet, right? So again, heading in the right direction. You can't predict predictors, but again, looking at the overall weight of the evidence, still doing positive. So how that concentration plays out in 2025 will go a long way in deciding market direction as we move forward. We really need to see this breath pick up to get too excited again. Also cause for concern is sentiment. Definitely see some improvement in the sentiment numbers. As you can see down here, we're looking at extreme optimism. So when this is high, there's extreme optimism in the market, which is a contra indicator, which means bearish, and down here is bullish. And you can see that it has been in the bearish zone, but it's heading in the right direction. Seeing improvement, but like inflation, still a long way to go, really, before it can provide some positive support. Elevated sentiment alone does not cause a sell off, right? It just increases the probability of experiencing one from these levels. So kind of summing up where we stand in the equity market, highly concentrated, overvalued at the headline index level, no doubt, but there are pockets of support away from the index. If you look to small cap international, so you still can take equity risk. You just want to be tilting into the right portions of the equity market. Strong trend support balanced with decreasing breadth and elevated sentiment puts the current bull market at a crossroads, right? As we turn the page to 2025. You need to be on high alert and in tune with any changes to the data when it provides a signal to a change in market direction. But for now, it still supports future price appreciation. So turn to the fixed income market, and we'll start with the yield curve because this really drives all the pricing in fixed income. And what a yield curve is just using the U.S. Treasuries. See that right here? So just got bonds issued by the government at different time periods, right? So they issue 1 month bonds, 2 month bonds, 1 year bonds, 7 year bonds, and what the interest rate investors are willing to pay as of 12/31, which is the blue line, for that maturity date. So again, as you expect, a normal yield curve up and to the right, because the longer the time period you lend money, the more interest you want to get. So what this is showing what happened in the quarter, you can see down here all the different movements at the different levels, is that acceptance of higher for longer. The yield curve steepened. And all that means is that the long end rose and the short end, which is a 1 month to like 1 year, fell. So it got steeper. That's indicating expected future growth, right? So again, it's kind of funny. That should be a good thing, right? But at least in December, it was not for equities and really had to do with valuations that we saw, right? At normal valuations. Yes, increased economic growth is good. Higher long-term rates good, but at stretched, not so much. If again, the way to look at this in the equity market is if growth is abundant, right? So this is indicating growth ahead, economy's going, which the data is indicating, there's no need to pay up for it. Like investors have been doing the Mag 7. You don't need to pay 30 times to get growth when you can get it at 18 times in other parts of the market, which is why we want to tilt into that. So again, yield curve showing what the Fed and the market all expects is that rates are going to stay higher for longer on continued strong economic growth. So continue looking over to the corporate market, and we're looking at spreads here. Credit spreads are pointing to future growth as well, as there's no dislocation. And all we're looking at here is we're taking that yield curve we saw before, and then how much more after that would a bank require for a company to borrow, right? Because a company is riskier than the government. All things being equal, we can argue that point till the cows come home. But in general, finance tells you that U.S. Treasury is a risk-free rate. Corporates borrow at a little bit higher rate. The high yield index, which is in black, is those more risky companies, and they buy at a higher rate. And all we really need to know is not the details, it's just that the lower this spread is, so the lower this graph is right here, the more confident banks are that they're going to get their money back. So lend to companies at a lower rate. So again, we saw there's lots of money slosh around the system. The economy is going well. Banks and private credit funds are happy to lend to companies at attractive rates. Right, so this is a good thing for future price appreciation. You can think about this as if we saw this kind of going up, start a strong rise in spreads, it would be cause for concern, almost canary in the coal mine type of thing. We're just not seeing it in the data. Something we're watching for, but for now, banks, private credit funds, seeing a very strong economy and very happy to lend to corporations out there, which should provide support for the economy. So looking at the fixed income market, a little bit more, that even with the higher for longer, fixed income can still play a vital role in portfolio construction. And not only for ballast in times of turmoil. Again, you've always heard the stories that, you hold this in case of volatility, but there is a big change. And I think as we turn the page here, you can see that we have real income to go along with the protection benefits. And what we're looking at here is different parts of the fixed income market. Treasuries we know about, munis is, when cities, public works issue bonds, corporates, just corporations issuing debt. Mortgage-backed securities, this is the government, right? Taking your mortgages, bundling them up, selling them to investors, that's that. Commercial, just Commercial mortgage, ABS, then credit cards, car loans, then you can go far afield, EM debt, overseas. What this is all telling you is that over the past 10 years, which is what it's tracking, is different yield to worth. So how much income and price appreciation you've gotten in bonds. And you can see that on average, it has been very cheap. Looking at just US Treasuries at 1.9. You can now get 4.5%. And if you're willing to go take a little bit more risk, you can get 5% income. So what that means is you have a little bit more leeway if rates stay higher or go longer because you're actually clipping a very nice coupon, right? There's a big difference between clipping 1.9% in a US Treasury when inflation's at 8% compared to clipping 4.5 when inflation is at 3% or 2%. So again, much better setup for fixed income, just like valuations in equity with the higher yield, you have a little bit more protection, makes it a little bit more attractive. So again, fixed income can still play a very good role in the portfolio. So we've talked about the fixed income market because so does play a role. We talked about the equity, the economy. Now we're going to put this all together and see this how it flows through to our risk modeling. And the first risk model we're going to look at is the NDR Fab 5, which stands for Ned Davis Research. An external data supply that we've used for many years over here, and I've known them for even longer than I've been at Stonehearth. Had 30 indicators broken down to 4 categories. And you can see the 4 categories down here. Tape, so you can think about trend, mean reversion, support that we saw from the S&P 500 chart earlier. Sentiment, we saw that chart we have from NDR. Monetary, we saw that in the beginning. Again, just how easy is cash floating around there. And we look at combo, which is just basically uses other models to input into this model. So you can think they go over international and just different parts of the market to put in. And this sums all up and gives you an idea of how much risk is in the marketplace. And again, it's not 100% accurate. It's not a predictor. It just gives you the weight of the evidence and says, what is the more probability like? Is it more probability for the market to move higher or lower? I mean, you can see that since we spoke last time, it's dropped by 2 to a -1. Needs to move below 2.5 before it turns bearish because it is on a bullish call. So again, so even though it is negative, it's still bullish. We did see the monetary and combo fall out of the bullish zone, but it did find support at neutral, right? So it didn't go negative. So although the data did decline, it really was not enough to move into the bearish zone, which is a very good sign. So looking at his weight of the evidence from the tape, sentiment, monetary combo, not a screaming buy in the marketplace, definitely weakening in the quarter, but the weight of the evidence taking all together is close, but still supportive of risk assets, which is similar to what we're seeing in our model, which is our own internal model. Now, for those of you who joined the call before, you know that our model is meant as a complement to Ned Davis. We do have some of the same data, but it's meant to kind of fill the holes I think he has in his model. A lot to do with valuation. Some of the economic data is a little bit different. So even though it's different, it's meant as a complement, we did see a similar drop as our internal model, which is designed to complement NDRs, fell by 1. And we see it remains just below the neutral line at -2. Valuation was the only thing to improve. You can see down here we have our subsectors too, and our valuation was a -6 last time we spoke. Now it's at a -4, so we saw that improvement. Really, as we saw earnings expectations start to flatline and level off as we begin to start 2025. But with like NDR, we saw a small drop in the technical picture. But it does remain positive in the zone at +2. So again, we still see a positive technical picture, even though it weakened, and that provides support for future price appreciation. Macro was the decider, and that fell to neutral as copper prices fell in the quarter, indicating a negative environment for risk, which hurt our macroeconomic indicator. But again, it didn't go negative. It did stay at neutral. So the economy is still finding support in jobs and new orders, economic activity. So still an overall positive influence on the investment environment. So taking both models together, weighted the evidence, bottom line, we saw a slight decrease in the attractiveness of risk assets, larger decrease in the Mag 7, right? So they became very less attractive in the quarter, but the weight of the evidence still leans positive until proven otherwise. So with that, see how this affects our asset allocation for clients. And again, this is as of December 31st, 2024, so it's the end of the year. We reserve the right to change in January, so there may have been trades placed in the fund since then. This is as of December 31st, 2024. So when we look at the quarter, there really was no trades in the quarter. Overweight equity, so we can see it right over here. But as we saw in the valuation picture on the trend, where you take risk matters. You want to tilt into valuation support, so we tend to have a little bit more weight in small caps. You can also see that, again, like we saw the valuation picture, international developed looks attractive, overseas assets, so overweight those. EM, when neutral, it's investable, but not cheap or expensive enough to get excited about or really nervous about. So you just want to have that market weight. Underweight fixed income, despite all the pauses we saw and the higher rates and stuff like that, we do think higher rates make it a little bit less attractive, especially compared to the equities when we see the strong economic growth. So you want to hold some and maintain healthy exposures in credit, and you definitely want to underweight duration, but still hold an underweight position in fixed income. Short end of the curve, like we saw, is a little bit more attractive at these levels than the long end. Look at opportunistic, we're overweight. We do see some opportunities in gold. We hold a gold position in this. And also our trend strategy is pointing to a good time to be taking risk in the marketplace and has some equity holdings in it. Cash, just better opportunities out there. Not horrible, and get 4% or so in the money market. But again, given what we're seeing with the economic backdrop, what we're seeing in the risk modeling, we just think there's better opportunities for clients' money, all else being equal, than sitting in cash. So, what are our key takeaways from today? What are we thinking about? What did we learn today from all the data that we saw? Well, first, Fed and market agree, right? Interest rates expected to normalize at a higher level. And why? Because of monetary conditions, strong employment market, really supporting higher rates for longer, right? There's no need for the Fed. There's no crisis that we see in the data, no high unemployment. Inflation is not weak. We don't see deflation anywhere in the data. So there's no need for the Fed to lower rates much more than they have already. Again, continued economic growth, right? Supporting risk assets, equities like economic growth, really supported by that strong consumer who's in a very good place. And despite the high concentration and elevated valuations, we see positive in the long-term technical backdrop. So still leaning positive for the equity market in the technical picture. We saw there was no signs of stress in fixed income, right? And remains somewhat attractive given the high current yields. We looked at our multi-factor risk models, right? They did turn down the fourth quarter. No doubt the environment got a little worse as probability stock market weakness has increased, but really not enough to change the overall picture. So we want to remain balanced, right? Tilt into tactical opportunities and take advantage of valuation dispersion. So with that, that's my kind of prepared remarks. I thank you all for listening to the presentation. And again, sorry for a little bit of hiccups in the beginning there, given what we're doing here. But with that, we'll kind of turn it over to questions and answers. And again, I apologize. There's going to be a little bit delay here since I am kind of running this myself here. So let me see if I get this pulled up and we can move from there. So let's see if there's any questions out there. All right, so here's a question. What is your best investment idea for 2025? Okay, well, thank you for the question. I mean, I do get this a lot, and I don't mean to snicker a little bit. I get these from clients, non-clients alike. I'm at a cocktail party or out with my kids' parents, friends. They always ask me, and although my answer is always the same, the outcome always isn't, right? My answer, and they don't like it, but it depends, right? Depends on your risk tolerance, depends on your age, wealth, goals, personal situation. What the best idea for one person, is not the same for another. The idea for I'm a 50-year-old male with a family, is it the best idea compared to my daughter who's 20 years old? We're going to have different investment goals, different personal situations, different risk tolerances. That's why we always take the time to discuss these things first before we make any investment recommendations with our clients. That being said, for my asset allocation chart, you can see where we see more attractive parts of the market, international, small caps. We still like the equity market that have valuation support. For individual stock holdings, we do have a stock portfolio that we run internally that invests in individual names that I can't talk about on a public call, so I can't discuss holdings, where we're positioned. But if anybody's interested in more of that type of portfolio, happy to have that discussion on a more one-on-one basis. Just give the office a call, ask for me, set up an appointment, and we can chat about that. So again, Long story short, it really depends on your risk tolerance and your personal situation, what the best investment idea out there is at any given time. All right, let's see what else we got here. Let's see, I agree with you. Okay. Um, okay. So one of the panelists asked, so we have too much government debt. I agree with you. I'm thinking I need to invest in gold or Bitcoin to hedge against the fiscal crisis. Do you prefer gold or Bitcoin? Um, Interesting. Um, Let me start as I think about this by giving you, really how I see Bitcoin and gold being used in a diversified portfolio and really what they represent. I can't recommend any individual holdings, right, on this call, but I can say we do include both assets in our investable universe, right? So there are both potential investments for diversified portfolio in our mind. Um, to me, so gold has been the traditional hedge, and we do hold some gold for any type of crisis, including government, as it's considered a safe asset, right? And we agree with that. It has performed this job well throughout history, and we see this continuing, right? We saw it in the last 2024 with it up almost 30% due to all the government debt being issued. Gold does serve that purpose of hedging some of the volatility in the market, and it makes sense given the U.S. government debt situation to hold some in a diversified portfolio. Bitcoin, it's a little bit different creature there. Hasn't been around as long as gold, right? So I think it is a different beast. Doesn't have that long track record. And really, rather than being a flight to safety asset, which it may have been in the beginning, but with the invention of the ETFs and the micro strategies, it really has morphed into more of a risk asset. And we've seen recently it trades more in line with volatile asset classes like equities than anything that can be considered safe, especially something that's down 30% at any given time. Tough to be considered a safe asset. This is the exact opposite of what you want for a volatility hedge. So given the two profiles, both can serve a purpose in a diversified portfolio, but to us, gold would be the protective asset in my mind, and Bitcoin would be more the risk on than protection. So if you thought it was a risk on market, head more towards Bitcoin. So I think we have time for one more here before we close down the shop. We're coming up on 45 minutes, a little bit over. So last question. What is your biggest worry right now? Biggest worry. Other than my children, and that's what you want to. For those of you who know me, right, have spoken to me, I worry about everything. It's a big part of my job, right? It's to worry about these things so our clients don't have to. So there's never one biggest thing. There's always a multitude of issues to worry about, but I think at least what's grabbing my attention the most right now is that, the persistently high interest rates, right? We saw the data is supporting all higher for longer. Interest rates go higher. We saw the debt and what that's going to do to the amount of interest we need to pay, this could do some serious damage to both governments, fiscal outlook, and economic growth prospects, right? Too high for too long can hurt and slow down economic growth. In other words, to me, it's the Fed, right? We're watching the data closely. Any changes to the signal from the underlying data, we see that in credit spreads, we see that in slowing GDP growth, a weakening consumer. Again, not seeing this at all yet, but it's just kind of on my mind that could be the next big concern and hurt to the market. So with that, I would like to thank you all for joining me and thank you for going through all little hiccups. For those of my friends who are in New England, please try to stay as warm as possible. It's a little cold out there. For everyone else, if you're in the South, I guess you're getting snow for the first time in a while. So other than that, I'd like to thank everybody for joining us. And again, if you have any questions, comments, and you want to reach out to us, please give the office a call or just shoot me an email. And again, thank you everybody for joining us. Thank you.